Welcome to the Deep Dive. Today we're cutting the ribbon on a stack of pretty fascinating source material. It's all focused on the global internet retail sector.
That's right. We've got curated stock screener data, and we're really zeroing in on the three giants that, well, currently dominate the global marketplace.
Exactly. Our mission here is to go beyond just, reading out numbers.
Right. We want to deliver an expert journalistic analysis. We're covering the fundamentals, the technicals, valuation, market sentiment, the whole picture for these top three companies.
The goal is really to synthesize this data, pull out clear, distinct market narratives for you.
And those three narratives, they're embodied by Amazon, Alibaba, and eBay.
It's quite a list, isn't it? A brilliant snapshot of the global economy, really. You got the high-growth U.S. engine.
Against the, let's say, geopolitical value play in China.
And then contrasting both with the highly efficient niche market veteran, eBay.
Precisely. Now, before we dive in, and because we are dealing with actual financial data here,
Ah, yes, the necessary bit.
we have to state the crucial context. All our discussion of prices, profits, scenarios, even our fun with paper money math later.
Which we will get to.
It all uses the provided historical data strictly for analytical and educational purposes.
Right.
This is absolutely not a recommendation for investment.
Understood. Important clarification.
Okay.
Let's unpack this, then. We have to start with the heavyweight champion, right? Amazon. AMZN.
Where else?
When you look at the basic data, what just jumps out immediately is the scale. Market cap soaring past, what, $2.6 trillion?
It's immense. But the recent news cycle, wow, it paints a picture of really intense, almost frantic activity.
Frantic is a good word.
Yeah.
We saw the stock surge, what was it, nearly 10%?
Look through 9.58%, yeah. On absolutely astronomical volume, over 166 million trades.
That kind of spike doesn't just happen. There's always a catalyst.
And this time, it was a massive Q3 earnings beat, plain and simple.
And the headlines were pretty loud and clear about why. The key growth driver is AI.
This isn't just buzzwords anymore. The sources point directly to the comeback of AWS, Amazon Web Services, being fundamentally fueled by this AI boom.
We're seeing references to internal projects like Rufus AI.
And significantly, Amazon's investments in outside players like Anthropic. It really confirms that narrative. Amazon is positioning itself to be the AI infrastructure winner.
It's the growth story everyone's watching, and the valuation seems to reflect that analyst confidence.
It does. The average target price is hovering just under $286. But, maybe more telling, you've got firms like UBS, Evercore ISI, Morgan Stanley. They're raising targets aggressively.
Into the $300, $335 range I saw in the report.
Exactly. High expectations.
Okay, I hear the AI story loud and clear, but a trailing PE multiple, currently up in the high 30s, 37 specifically, isn't the worry that this AI boost, this optimism is maybe already baked into the price?
That's the classic risk, isn't it? When you buy a growth engine like Amazon, you're paying a premium today for what you hope is near-perfect execution tomorrow.
Leaving not much room for error, or maybe genuine upside for new buyers right now.
It's a valid concern. However, the financials, they do offer some justification for the optimism. I mean, look at the profitability. Return on equity, nearly 25%. Solid.
Okay.
And while their operating margins aren't like a pure software play, the overall profit margin is still decent, over 10.5%. And crucially, their EPS year over year for the trailing 12 months, an explosive 56%.
Wow, 56%. Okay, that shows they can convert that massive scale into actual profit.
It proves the model works when firing on all cylinders.
All right, let's dive into the technicals, the price action. Well, it screams momentum, doesn't it?
Oh, definitely. Performance last week, last month, consistently strong, around 9% to 10% gains.
And the stock is trading significantly above all the major moving averages. The SMA 200, that long-term health indicator, it's nearly 14% below the current price.
Yeah, that indicates real long-term bullish dominance. Strong underlying trend.
But I think there's always a but in technical.
Hey, usually. While that long-term strength is compelling, there is a little technical caution flag waving. The RSI, the 14-day Relative Strength Index, it's currently at 67. Now, if that crosses 70, many technical analysts see that as overbought territory.
Meaning the momentum might be getting a bit stretched in the very short term.
Exactly. It suggests strong bullish momentum, absolutely, but maybe one that's nearing exhaustion. Something to watch.
Okay. Let's run our first paper money scenario.
Yeah.
Just to illustrate the raw power of that recent earnings surge for AMZN. Let's imagine you placed a paper trade, say $5,000 worth of shares, right before that Q3 announcement hit.
Okay. The previous closing price was $222.86.
Right. So at that entry price, $5,000 gets you About 22.44 shares.
Approximately, yes. 22.44 shares.
Now, if you sold those 22.44 shares at the recent closing price we saw, $244.22, that nets you a paper profit of $479.54.
Almost a 10% gain, basically overnight, purely fueled by the market's reaction to that AI narrative and the strong Q3 beat.
It's a good illustration. And, of course, we should note, those 22 shares, they're a tiny, microscopic fraction of the over 10.6 billion shares Amazon has outstanding.
A drop in the ocean. Okay, so if we connect this to the bigger picture, we move straight to Alibaba.
And this story,
Yeah.
it feels like the absolute inverse of Amazon in many ways.
It really does. Still a titan, of course, market cap around $382 billion. But its narrative is just completely defined by its geography, by the regulatory climate in China.
Yeah, that environment definitely seems to create volatility. We saw the stock close down a couple of percent recently, and while its year-to-date performance has been huge,
Up over 100% since the 52-week low, yeah.
it's been under pressure more recently, down almost 10% just in the last month.
And the key news themes, they're always this mix, aren't they? Internal innovation versus external political pressure.
Right. On one hand, they're pushing their own AI, Quinn models, smart glasses, trying to compete with Tencent and others.
But those moves always seem overshadowed by geopolitical stuff. The whole Ant Group saga continues. The threat of renewed U.S.-China tariffs never really goes away.
It feels like a constant headwind. But if you could somehow strip away that geopolitical risk layer, the raw valuation of Alibaba looks, well, pretty attractive compared to U.S. peers.
It's the definition of a value play, potentially. You're looking at trailing PE multiples in the mid to high teens, around 19.88.
Compared to Amazon's 37, that's a huge gap.
And the forward PE is even lower, about 17.85. The market is clearly applying a massive geopolitical discount here.
What's fascinating, though, is you mentioned its profit margin, nearly 15%. It's actually higher than Amazon's.
It is. It shows there's underlying operational efficiency there, despite the external pressures. The core business model is profitable.
So the bull case for Alibaba seems entirely built on recovery and maybe stabilization. We see their EPS is projected to rebound sharply next year, up over 36%.
Right, which is meant to compensate for a projected negative EPS this year. So, yeah, it's a high-stakes bet on things getting better.
It is. And the technicals seem to reflect that uncertainty, too.
They do. The 20-day simple moving average, the SMA 20, is showing short-term selling pressure. The RSI is just neutral, right around 50.
But here's a fascinating technical point you flagged. It's beta.
Yeah.
It's extremely low, 0.19.
Yeah, beta measures sensitivity to the overall market, right? So even though Alibaba itself is subject to these wild swings based on headlines.
It suggests that when the S&P 500 moves, Alibaba doesn't necessarily move with it.
Exactly. It trades more on its own unique drama, its own news cycle, rather than broad market sentiment, which is interesting.
Okay, let's analyze that high-risk, high-reward nature with another paper money scenario. This time, let's imagine a longer-term investment, buying near the 52-week low, which was $79.43.
Okay, a real bottom fishing entry.
And then selling at the current close price of $170.43. Our $5,000 initial paper investment, at that low price, it would have bought roughly 63 shares.
63 shares, correct.
Selling those 63 shares at the higher $170.43 price point. Well, that results in a massive paper profit of $5,730 at.
Wow. That really showcases the rebound potential, doesn't it? When a stock gets heavily beaten down by factors maybe not directly related to its core operations.
A huge potential gain, reflecting that volatility. And again, for scale, those 63 shares are out of a total share count of about 2.24 billion.
Still small potatoes in the grand scheme.
All right. Now let's turn to our third player, eBay. Ticker eBay. We're moving from the global growth giants to a smaller U.S.-based veteran, market cap around $37 billion.
Solid, well-known name. But the recent data, well, it tells a very different story compared to Amazon, for example.
Yeah, it closed down nearly 3% recently. That contrasts sharply with Amazon's positive surge we talked about. Why the big difference?
Well, this looks like a textbook case of outlook disappointment completely overriding a financial beat.
So they actually beat their Q3 earnings estimates.
They did. But the stock still sank sharply right after the announcement. Why? Management gave a weak profit outlook for the holiday period.
Yeah, that'll do it.
Yep. It immediately sparked fears about margin compression, increased competition. You know the drill.
But if we look past that immediate reaction, at the fundamentals, eBay looks like the deep value play of this whole group.
It really does. Its PE is the lowest of the three, sitting around 17.69. And its forward PD is even lower, down near 13.72.
That's a significant discount, even compared to Alibaba.
It is, and this is where you get real insight into the business model itself. Why is eBay so efficient? Look at the profitability metrics.
Okay.
Gross margin, exceptional, 71.50%, and return on equity, sector leading at over 42%.
Wow, compare that to Amazon.
Exactly. Amazon runs on lower margin logistics, cloud infrastructure, eBay. It's mostly a pure marketplace. They take a high margin fee for connecting buyers and sellers. They don't have the massive overhead of warehousing or shipping like Amazon does.
That efficiency, that's the core strength that keeps analysts interested, even with a weaker outlook.
Precisely. It provides a strong foundation.
We also noted eBay is the only one of these three that actually offers a dividend yield, currently 1.41%.
Another point for the value-oriented investor. Strategically, the news also highlights their focus on specific high-value categories, think collectibles, auto parts.
And their acquisition of social marketplaces like Tice.
Right. It looks like an attempt to counter those margin fears by really driving engagement in these potentially higher margin niche areas.
Okay, turning to the technical analysis for eBay.
Yeah.
The short-term picture looks, well, frankly alarming.
It does. Performance over the last week, down over 16%. That's a big drop. And the stock is trading well below its 20-day moving average. Suggests pretty extreme selling pressure right now.
However,
that
kind of extreme weakness pushes the 14-day RSI down to 30.62.
Which is right on the cusp of, or maybe even in, what technical traders call oversold territory, typically below 30.
And that's often viewed purely technically as a potential buy trigger.
Right.
Suggesting the negative reaction might have been overdone.
It suggests a potential for a mechanical rebound, yes. That the selling might be exhausted. It's a contrarian signal.
Furthermore, we saw the current price, around $81.31, is significantly below the average analyst target price of $95.83.
Yeah, that gap really underscores the market's current pessimism versus the perhaps longer-term structural view held by analysts on the street.
Let's run our final paper money scenario then.
Yeah.
A trade based purely on bridging that gap, on hitting the analyst target. Let's say you buy $5,000 worth of shares now at this depressed price of $81.31.
Okay. That purchase gets you approximately 61.5 shares.
Now, if the stock were to recover and eventually reach that average analyst target of $95.83, selling those shares would yield a paper profit of $893.98.
A solid potential gain. It represents the capital appreciation possible if the market sentiment eventually aligns with that longer-term analyst outlook.
And those 61.5 shares are out of about 457 million shares outstanding for eBay. Smaller scale than the others.
Definitely.
So wrapping this up, what does it all mean? We've dissected three really vastly different stories playing out in internet retail.
We really have.
You've got Amazon, the high-growth, high-valuation AI winner, but maybe priced for perfection.
Then Alibaba. The deep value potential, absolutely burdened by geopolitical risk, but with this massive projected EPS rebound if things go right.
And finally, eBay. The highly profitable veteran, currently oversold because of outlook fears, but whose strong margins maybe offer some downside protection.
Yeah, the contrast in valuation and risk, that's the core takeaway here, I think. Amazon's premium PE, that's market confidence in continuous rapid growth powered by AI and AWS.
While the lower PEs for eBay and Alibaba,
they reflect market anxieties. Competition and outlook fears for eBay, straight up governmental risk for Baba. The multiples really tell you exactly where the market sees the most certainty and the most fear.
A very clear summary. Thank you for sharing this source material with us and allowing us to perform this deep dive for you.
Absolutely. And as we wrap up, maybe consider this final thought, especially regarding eBay. We noted that despite that sharp drop after the weak outlook, institutional ownership is massive, that 96.25% figure.
Almost completely locked up by institutions.
Right. So how much does a single quarterly revenue miss or a slightly weaker profit outlook actually matter in the long run if institutional investors already hold nearly every available share? Does that high institutional conviction maybe act as a kind of floor? Does it mitigate the short-term negative news, prevent a truly catastrophic decline?
That's a fascinating question. Conviction versus short-term panic.
It's the ultimate question, isn't it? Something to mull over.
A great way to frame the future for all three of these retail giants. Until next time, keep those sources flowing. We'll see you soon for the next deep dive.